Told you not to buy real estate. Previous videos we covered how single-family rentals generate negative cash flow in today's environment. And today we're going to talk about retail real estate and show how that generates negative cash flow as well. And if you missed the single-family video, go check it out. It's on our profile. Now I went and found the first single-tenant retail property we could find. This being really one of the simplest property types, so it'd be really easy to cover in a TikTok video. Now the property we found is a triple net lease property in Newland, North Carolina. Now, triple net means that the tenant pays most of the expenses, so property tax, insurance, and maintenance. So it's really one of the simplest property types for you to own as the landlord. This is a 9,100 square foot facility leased to a Dollar General store. It's a 5-year lease with 5-year renewals. At every renewal period, there's already a built-in 10% increase in your rental revenue. So looking at this specific property, they have a pretty good tenant in Dollar General. It's a pretty good credit. When looking at something like a triple net lease, the credit quality of your tenant's a really important factor. How likely are they to continue to make those payments throughout the life of their lease? But for this particular business, I'd say the location's not great. It looks like it's kind of in the middle of nowhere. There's not a lot of other things around. So that means if Dollar General ever were to leave or choose not to renew, it's going to be very difficult to release this property. So now this property is listed for $1,974,648, which is about $217 per square foot. Now it generates $102,000 in trailing net operating income, which is a pretty good gauge for our true cash flow because this is a triple net lease property where most expenses are passed through to the tenant. Now, the way that you evaluate real estate is what's called its cap rate. And so basically that is the net operating income, the NOI, divided by the price of the property. This particular property is a 5.2% cap rate, which you can also look at that as kind of an unlevered yield on this investment. So for financing, we're going to consider a conventional loan that requires a 25% down payment. And the current rate on those loans are about 7.5%, and they have a 15-year term. Now, right off the bat, we don't have to do a lot of calculations for me to know that 5.2 is less than 7.5. So we already know that this is a negative return investment. Now, you could pay cash, but I'd rather go and just buy some bonds or publicly listed stocks or just about anything that's simpler and will generate a higher return than the 5.2% cap rate and the likely price decline that's going to need to come for the market to get in balance with where cap rates are and where financing rates are. Now let's do the math anyway. So the loan payment is $14,000 per month and the cash flow is roughly $8,600 per month. So that means your negative cash flow is $5,600 a month. That's why we're focusing on operating businesses. Now, they take more effort than real estate. They are riskier than real estate investments or just going and buying an S&P 500 index fund. We've never advertised that anything is easy or without risk, but they can generate life-changing cash flow, and we think that's worth making the extra effort, taking the extra risk if done correctly. So let us know if you have any businesses you want us to look at. Leave your questions in the comments and follow us for more.